Good day viewers, let's discuss how to read and interpret financial statements today. Understanding how to read and interpret financial statements is essential for investors, business owners, and anyone involved in financial decision-making. Financial statements provide valuable insights into a company's financial health, performance, and profitability. Here's a comprehensive guide on how to read and interpret financial statements effectively. 1. Types of financial statements. A. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It consists of three main sections: assets, liabilities, and equity. Assets represent what the company owns, liabilities are what it owes, and equity reflects the ownership stake of shareholders. B. Income statement. The income statement, also known as the profit and loss statement, summarizes a company's revenues, expenses, and net income or loss over a specific period. It shows how much money the company generated from its operations and the resulting profitability. C. Cash flow statement. The cash flow statement tracks the flow of cash into and out of a company during a specific period. It consists of three main sections: operating activities, investing activities, and financing activities. The cash flow statement provides insights into a company's liquidity, solvency, and ability to generate cash. 2. Key components to analyze. A. Liquidity ratios. Liquidity ratios, such as the current ratio and quick ratio, measure a company's ability to meet its short-term obligations using its current assets. These ratios assess the company's liquidity and ability to cover immediate financial needs. B. Profitability ratios. Profitability ratios, including gross profit margin, operating profit margin, and net profit margin, evaluate a company's ability to generate profits relative to its revenues, costs, and expenses. These ratios measure the company's overall profitability and efficiency in managing its operations. C. Solvency ratios. Solvency ratios, such as the debt-to-equity ratio and interest coverage ratio, assess a company's long-term financial stability and ability to meet its debt obligations. These ratios evaluate the company's leverage, debt levels, and ability to service its debt. 3. Comparative analysis. A. Trend analysis. Compare financial statements over multiple periods to identify trends, patterns, and changes in key financial metrics over time. Analyzing trends helps assess the company's performance trajectory and identify areas of improvement or concern. B. Benchmarking. Compare the company's financial performance to industry peers, competitors, or benchmarks to gauge its relative strength, competitiveness, and position within the industry. Benchmarking provides context and insight into the company's performance compared to its peers. 4. Common size analysis. A. Horizontal analysis. Horizontal analysis compares financial data over consecutive periods to evaluate changes in absolute amounts and percentages. It helps identify growth rates, fluctuations, and trends in financial metrics over time. B. Vertical analysis. Vertical analysis expresses each line item on the financial statements as a percentage of a base figure, typically total revenue or total assets. It helps assess the composition and proportion of different components within the financial statements. 5. Interpretation and decision-making. A. Financial health. Evaluate the company's financial health, stability, and sustainability based on its financial statements. Assess key indicators such as liquidity, profitability, solvency, and efficiency to gauge the company's overall financial well-being. B. Investment decisions. Use financial statement analysis to make informed investment decisions, assess the valuation of stocks or securities, and identify investment opportunities based on the company's financial performance and prospects. 6. Conclusion. By understanding the components, ratios, and analysis techniques used in financial statement analysis, individuals can gain valuable insights into a company's financial performance, make informed decisions, and navigate the complexities of the financial landscape effectively.